Hey, welcome to a Wiser Retirement podcast. Leaving a financial legacy isn't something that happens by accident. It takes planning. We've put together a guide with 7 steps to leave a financial legacy and have made it available for free on our website. This guide covers designing your legacy, estate planning, financial education, and protecting your legacy. The link to download 7 steps to leave a financial legacy is listed in the episode description, or you can go to wiserinvestor.com, scroll to the bottom, and find it there. Now on to today's episode.
Welcome to a Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom is my co-host today, Brad Lyons. Hey, Brad.
Hi, Casey.
Today, we're going to focus on how to design your portfolio to leave a lasting legacy.
Well, it's an interesting topic, actually, because we're talking about constructing portfolios that could last a very, very long time and withstand the ups and downs in the marketplaces at the same time. So, very interesting topic today. I'm glad that we're covering it.
So I think we need to start at the very basics. When you think about financial planning, and we talk about this a lot throughout all of our podcasts, financial planning starts really with the first step: no stupid debt. And that's kind of a harsh phrase, and it feels a little judgmental, maybe. But the whole point is, people say there's good debt, there's bad debt. Dave Ramsey says all debt's bad. But ultimately, we don't like seeing our clients carrying 18% interest on credit cards. Okay, I call that stupid debt. There's nothing worth 18% interest.
Well, what's happening in that scenario is people think that when they're borrowing money off their credit card that they're increasing their credit. Okay, and they think that's a good thing. Well, the marketers at these credit card companies may be some of the best advertisers and marketers in the world, because They have convinced an entire society that it's a good thing to carry this debt at a very high rate of interest. The only people that get rich carrying high credit card balances are the people at the credit card companies.
Oh, yeah, absolutely. I don't want to go down this rabbit hole entirely, but I get so frustrated with people talking about inequality, when it comes to financial services. Oh, well, certain aspects of our society don't get access to certain kind of credit and blah, blah, blah. And I'm like, that's part of the problem. Like, the problem is that the majority do get access to that kind of credit is the problem, right? It's like we don't want to be slaves to payments, and that's what all that gathers. And we have lots of podcasts where we've talked about how to get out of debt, why debt's bad, how to pay off your mortgage, and you can go back and reference those in the past. But ultimately, the way to leave a legacy is not to leave a credit card balance.
That's right.
Right.
That's right.
So let's just say no bad credit card debt. No even low interest credit card debt. Get rid of the 0% credit card debt. Just no credit card debt. I mean, the bankers are making a fortune on people.
Yeah, bankers aren't stupid.
And then salespeople are pushing these products for $29.95, and you pay for it like your entire life, right? Mm-hmm. So we get rid of credit card debt. We want our primary home, to be on track to be paid off prior to retirement. We really don't want auto debt. Some families have to carry auto debt, but I think it's much better to drive an older car, higher mileage, and pay for maintenance than it is to be carrying a monthly credit card bill or auto loan.
Yeah, I agree. And I think in a recent podcast, we even talked about what the average car payment is
like
on a monthly
$680 a month now.
It's just amazing. Yeah.
So we really, we check those boxes. We're not building legacies driving cars we can't afford. That's not building a legacy.
No.
The next step is emergency reserve. So, and before you even get into investing, you want to make sure that you never have to go liquidate that portfolio because you've hit some hard times. So you want to create a cushion between you and your investments in the future, right?
Yes, that's right. And the reason is because for some reason that's beyond me, whenever the market has its ups and downs, especially its downs, is when things go wrong at the house as well.
Right.
When things go wrong, things go wrong. New tires, new roof, new washing machine, new air conditioning unit.
Yeah.
The last thing you want to be doing is to liquidate a portion of your portfolio to pay for these items. That's what the emergency fund is for.
Or let's take it to some of, maybe our clients out there who are business owners. That's when business sales are down,
yes,
right? Or,
that's right. Right.
Or you have to pay more for talent or, whatever. You're not prepared. And next thing you know, you're having to liquidate your brokerage account in order to cover expenses. That's not a good scenario either.
No, it's not.
So you want to carry a gap. For business owners, our gap is probably, it's not 6 months. It's very different how you analyze emergency reserves for business owners, especially for medium-sized, large companies. Mm-hmm. Hopefully you have your own business reserves separate from your own personal reserves, ideally. But you want to create those reserves so that you can go on to the next step. And that basically is retirement planning. So am I saving enough for retirement? So you got to take care of yourself before you take care of others, right? You got to make sure you're on track for your own retirement. You can't borrow money for retirement. There's no retirement loans.
I was just going to say that.
Right? So you got to make sure you're on track for retirement. That's where retirement planning comes in. And then once you know that you're on track for retirement, you need to come up with a college plan. Ultimately, I think the best legacy to give is to be able to pass on a college education debt-free. And maybe the child has to work to cover part of that. Even if you don't have money for college, I don't think the child should have any college debt. You got to figure out another way to pay for it. The ROI just isn't there.
No, and we're seeing that students who come out of college with debt have a very different experience in their careers and their lives than those that don't come out with debt. Being saddled with these payments that can last 20, 25 years, beyond college is just something that is holding back people from buying homes, moving, to new locations, taking a job that there is some risk taking, but the reward is very high because they can't afford the risk because they're settled with these debt payments.
Which is another reason why you don't have credit card debt. There's another reason why you have cash reserves, right? We get that question all the time. What do I do with my reserves? Am I getting paid any interest? And well, the ROI on a reserve, when you've lost your job, but you're waiting for the perfect job to come, and let's say you wait 8 months instead of 3, and now that 8th month wait has yielded $100,000 more in income, the ROI on that cash is huge, right?
Yes, it is.
So that's how you have to think about it.
Right.
All right. So now we know that we're saving for retirement. We know that we've got a college plan in place. And then after that, times are good. Brad, what do we do with extra assets? What do we do with company profits? Where does that roll? And we call this
the legacy fund.
Yeah, or opportunity fund.
The opportunity fund.
Yes.
It's the question I get most often in a plan is, what do I do with that next dollar? Mm-hmm. What do I do with the next dollar after I've done everything else?
Yep.
Now what do I do? How do I elevate that to get the maximum benefit from it, not just from a return standpoint, but from my family and my lifestyle standpoint? How do I get the benefit of that I've worked hard for and earned? Because theoretically, it's one of the last dollars earned.
Yep.
Okay. In your job. Okay. In your income. Okay. Because the first dollars earned go to pay the basics of life. Mm-hmm. Then the next dollar is for retirement. The next dollar is for college. And then finally you get to that opportunity zone area where it's like, okay, what can I do with this next dollar that I get a tremendous amount of benefit from either now or in the future? And we're going to talk a little bit about what to get a benefit ways to benefit from it in the future.
So the topic is designing your portfolio to leave a lasting legacy. I don't know that your opportunity fund, your legacy portfolio has to be a whole lot different than your retirement portfolio in terms of what's in it. But the percentages could be very different. So ultimately, this is money that you're probably not going to need, right?
Right.
And we call it the opportunity fund because an opportunity may come up and you may want to withdraw it. So sometimes it's more conservative because it's always ready for the next deal, right?
Right. And so that is the point, that it has a little bit, perhaps may has a little bit more liquidity in it because you don't know when that opportunity is going to come.
So a lot of times a client will have a goal for a beach house or a lake house or a mountain house. And so we said, well, we don't have any opportunities to do that right now, but I'm going to put this extra X amount of dollars every month into this other account or every year, my bonuses. And then I want to see it grow over time. Typically looking out 5+ years, right?
Right.
And someday I might liquidate that, and then I might go make that purchase. Or other days, or other times, maybe these be like, no, I'm gonna make that my primary home, and I'm just gonna leave this opportunity fund by itself just to keep growing. So building that, again, the strategy isn't that much different than how we build normal portfolios, except you could be much more aggressive with it, right? If you wanted to be, if it's not going to be liquidated. Yes. You could be more aggressive with it. So you have to define the objective. But in our example today, let's assume that a family just wants to build wealth. So this is above and beyond, and they don't have any particular strategy other than I'm gonna get this money to keep growing. Mm-hmm. I love the idea of making it eventually a family bank. Children, grandchildren want to borrow money to build a business, to generate more wealth for the family, right? I like knowing that there's this fund here that could do that someday. And so there's lots of ways to do that. But let's start. How do we construct that? Let's assume that we've got $500,000 in this account. How do we start structuring that?
There's a couple of different ways to look at this. If you want to construct it in the same manner that a investment professional or an institution would construct it in order to meet an objective at some point in time out in the future, even though that you may not know exactly what it is or when it is, but you know that it is at some point in time, you want to make sure that you are covering all your bases in the investment universe, because you don't know exactly where the return is going to come from. It's almost a better way to answer this is how not to invest it, okay? And to answer it sort of in that manner would be, do not think that this is money that you can gamble with. And that's often the way people do think. Well, it's extra money. I'll just throw it out there and see where I can get the biggest return. That's really not the right approach, because there is an actual endpoint to this, and that is the life event, the occurrence that, as you call it, that is going to happen at some point in time, whether it's the liquidation to buy a home, a second home, a whatever, to create a family bank and to pass it on as your legacy. That's still an event that's going to occur. Mm-hmm. And so the portfolio needs to have a probability of success where you can somewhat predict how much it's going to grow over long periods of time in order to have some idea of knowing what's going to be available for you in the future when that opportunity comes along. And do I need to add more to it, or do I need to grow it faster? So
a simple time value of money calculation could potentially help you with that.
It would be a great place to start. Exactly. Yeah. Yes. So it's based upon how much you're going to put in, how long a period that you're going to put it in for. The way an institution would look at this is, look, if I think I can get a return of X from the market, the stock market, and a return of Y from the bond market, and I have a total return calculation that tells me I need somewhere in the middle there, I would combine a well-diversified stock portfolio and a well-diversified bond portfolio in a proportion where I lower my risk and increase the probability of my return over this same period of time. That's the way an institution is going to look at it. The way individuals often look at it, they put some money in the stock market and hope something happens. Hope is not really an investment strategy here.
Or we just see a hodgepodge of individual securities.
That's right.
With no rhyme or reason.
That's right. They buy them from time to time thinking it's a good idea.
Yeah.
Buying is easy. Selling is hard.
Right.
Okay. Knowing when to sell. And interestingly enough, constructing a portfolio is a lot like constructing a home or something else. One part affects the other part. When you throw that hodgepodge of securities together, they're affecting each other,
right? And
not always in a positive manner, okay? Because industries within the stock market and in our economy sometimes move in tandem, sometimes move in opposite directions, okay, and sometimes then work against each other. In a well-constructed portfolio, each security that's put in the portfolio is chosen for a specific reason, and it has a certain amount of risk to the portfolio, and it has an expected return in the portfolio. And we do this through utilizing ETFs.
Yeah.
So what we're looking is broad asset class diversification, large cap, small cap, international stocks, combined with a ETF for bonds, either short-term, long-term, investment grade, high yield, etc. But all these are put together and constructed in such a way that they each have an expected return, a predictable standard deviation, a range of returns, and an expected outcome over a period of time. Okay? And by building the portfolio like that, you can begin to have plans for that opportunity of when it comes along. You have the portfolio ready to go and able to be utilized in order to take advantage of that opportunity. An individual stock here, individual stock there is not an investment strategy whatsoever.
No, it's not. I have this vision, and obviously it's more than $500,000 to do this. So I'm kind of running my own example, but especially for very wealthy families where you have a sale of a business or you have tremendous cash flow from a cash cow kind of business. What do you do with those assets? I see it as like a third in real estate. Not a REIT, but actual real estate. It's the horse farm. It's the it's the beach house or whatever it is, or multiple. Could be a lot of $300,000 properties. I don't know if there is a $300,000 beach house anymore. I don't think there is, but point is you have multiple.
They're real assets.
Real assets that are generating income.
Yes.
So you're renting it out, or you have maybe a business there that's making money, and then. Honestly, your stocks and bonds could be so simple. I mean, think about it. You could just buy VTI, which is right.
Right. It's the total U.S. stock market.
Yeah. Mm-hmm. So that's the entire U.S. stock market.
At what, 2 or 3 basis points?
Yeah, it's basically free.
Exactly. Yeah.
And then you could have a total bond allocation to help balance that out, but it doesn't have to be complicated.
No.
And that's the part that I get frustrated with our industry is I think that there's this secret sauce, and there is no secret sauce other than patience and going against the grain sometimes. But we have people out there in our industry get paid, big commissions, big fees. And really their job is to keep people on the tracks. The value is in the planning, right? And the foresight, not necessarily in the portfolio itself, other than keeping you from doing stupid stuff, meaning the client, right? You're going to hit the eject button at the worst possible time. And it's just making good decisions. For most of us, we're not Elon Musk and say, I'm fed up with Twitter. Or is he buying Twitter? Is he not buying Twitter? Who knows? But it doesn't even matter. The point is,
it's amazing we can even think of it that way.
Right. I know, right? A $44 billion purchase is, I'm sure you had to put a little effort into it, but in the end, it wasn't probably that big of a deal. Ultimately, for most of us, we have to make choices. And so that's where it goes back to, do I have a $680 a month car payment, or do I find something I can pay cash for? And then I'm going to put this money on the side over here because 3 generations from now, they're going to really benefit from this. Right?
Yeah, so, I love the saying that we use around here about Warren Buffett saying somebody sits under the shade because somebody else had the foresight to plant a tree.
That's right. That's right. Actually, our director of operations found that. I think it's on our website somewhere. It says on our careers page, I think, on our careers page on our website. But yeah, no, that's very true.
It is.
That's very true. And actually, we have a new client that we're working with right now that is so frustrated with his family because they own all this acreage in South Georgia, and it just sits there. It's not being used for anything, not even leased out to for cows or anything. So he has this idea that he wants to try to acquire the property as people pass away, and he wants to plant acorn trees, pecan trees, right? So but those pecan trees, he'll probably never see a harvest it'd be his kids. And he goes, it won't generate a tons of money for them, but it generated a nice little income because the trees are easy to grow. They're fairly easy to harvest. And he can do it on like 200 acres, I think. But the idea is that instead of having land sit in the middle of nowhere, which has increased in value, but nothing like metropolitan areas, right? Suburban areas. So that, like, literally this guy's focused on building a legacy. And to him, it's kind of this wild hair, but as a planner, I'm thinking, oh my gosh, I think I can get you there. Like, looking at income and asset debt, at debt that can easily go away, and thinking, man, I think we could do that, So it's thinking beyond and bigger than yourself. And you have to remember, like, when you're managing a pension or you're managing an endowment, how long does it have to last? Basically forever.
Yeah, exactly. It's almost an infinite time frame,
especially for educational institutions and
That's right.
and their endowments, right? So this stuff has to last a very long time. And so when you start peeling back what they're invested in, it's the S&P 500. There's some that are famous for their commodities purchases many years ago, which then eventually failed, and ultimately they're just back to holding low-cost ETFs, right? And so we have to think of it the same way, that we're creating this nest egg, this bank for ourselves, and it's going to go up and down in value. It's going to have really bad years. It's going to have really good years, and ultimately you're pulling this income off of it and some of the earnings from the growth to live on. But so once you have enough for yourself, then as you start building this legacy fund or this opportunity fund, you're pretty much managing it the same way. You just be more aggressive. Now, when I say more aggressive, I don't mean more small cap stocks. I just mean you can have more in S&P 500 than in U.S. Treasuries, right?
Yes.
And that money shouldn't have to be touched. So essentially, you should be able to build a portfolio that costs you next to nothing, that can help you build wealth. And then as it grows in size, you shave off a little bit and say, oh, okay, I want to purchase this property, or I want to purchase this property. And those properties then need to generate income as well.
Right. And that goes back to the idea of how to divvy up the portions of the portfolio.
Yeah.
Where we started talking about how a third of it could be in real assets. But those real assets also produce income.
Yeah,
be it
absolutely.
the farm, and be it the rental house, or whatever that you get to use at the same time.
Yeah.
So
yeah, I'm not about long-term rental properties, like the monthly ones. I think in this environment that doesn't make a whole lot of sense, because only way you make money is that you bet that their prices are going to continue to increase, and I don't think we're in that market right now. So what I like is the vacation rentals.
Mm-hmm.
It's something that you can actually use for your own family. You can create memories there. Maybe it's a place you all gather for Thanksgiving, or it's a place you go into every week or 2 weeks out of the summer. But then the rest of the time, it's open for income producing, right?
Right.
And so that money comes in, pays for the operation of the unit of the Airbnb or VRBO, whatever you're doing with it. And then you have the portfolio that's still growing. Ultimately, the whole purpose of this quarter is how do we leave a lasting legacy. Ultimately, you have these properties that are generating income for you. Then you have on the other side of this, you have a portfolio or maybe cash set aside that the next generation can then move forward with their ideas.
Exactly. And as these properties, for example, and investments throw off income, okay, and this is really the point where they begin throwing off enough income where that income can be redeployed in a significant manner, either in the plan of the fund, what the plan of it is to make gifts, to family members, to pay for education for family members, to provide them with opportunities for their own personal development and growth, and business opportunities to buy homes, etc. But it's the income that's produced and generated from these, different investments that really make the difference. The cash fund, okay, is there to like the family bank or something like that, where you can borrow from it in order so that one family member needs a large cash inflow, okay, or outflow from the fund, inflow to them, but it doesn't, affect the other family members, so you create a loan.
Right.
Okay. Rather than having to disturb investments or sell property, the cash fund is there for that sort of thing. So there's lots of different ways to set this up and utilize it so that everybody gets the maximum benefit from it. Okay. Well, you're keeping good track and good accounting of it, making sure that everybody, all the beneficiaries of the fund, be it current generation and next generation and future generations thereafter, all are able to participate in what might be a meaningful manner to them.
Ultimately, we're going to talk about this in a future podcast, but ultimately it comes down to educating the next generation about money.
Yes.
And, they probably grew up with a very privileged lifestyle, and helping them understand how that happened and how you can lose it. But more importantly, just what do you do with a dollar when you get a dollar? And I wish that it's not in Georgia. It's now required to have that senior year. I don't know how many people pay attention to it in class, though. That's something we have a Meredith.
That's in the school curriculum?
Yeah.
I think it's about time.
We have a Meredith City School board member coming on the podcast here in the next few episodes. And that's one of the questions I asked him is like, well, how do you measure success with that? Because I'd like to know, even in my own kids' school, how do because they take a Dave Ramsey class. But again, I don't know how seriously it's taken. And I don't know if the person teaching it is the best person. And I have no reason to believe that they're not, but, probably maybe at least make the math teacher do it right. Not the lit teacher. But, yeah. So, when it comes down to, getting back on topic, designing your portfolio, if you will go back and listen to episode 102, we talk about low cost, diversified, long-term investing. That's a great episode on getting into the nuts and bolts of how to build a portfolio. We have episode 87. That's a while back ago, but we talk about the strategies to grow and protect the portfolio. And then if you want to learn a little bit more about investment portfolios for your retirement, we have one more recent, episode 104. And also check out our YouTube channel as well. We have many different investment topics in our educational videos as well. But ultimately, you want to focus on low-cost investing. Stay away from all the weird stuff. I saw an advertisement recently for a fund that buys life insurance policies on people.
Oh.
It's just like
viaticals, I think they're called.
Yeah.
Oh my goodness.
I'm like, oh my gosh. And then the option strategies.
Yeah.
All the get rich quick stuff.
Right. They all come and go.
Yeah.
Okay. But the point here is that the strategy and this opportunity fund that you're going to use for a legacy is going to last for generations. So why invest in a fad that's going to last a season?
Right. Exactly.
Rather than a lifetime.
Right. Yeah. The Beanie Baby investments from the early 90s. It's not such a good one now, right? Stay away from modern day Beanie Babies. But yeah, it's so simple, but yet we make it so complicated. And I think that's just human nature. We also believe that someone out there is making money. Someone out there is making money doing this. And the reality is, and I've been doing this for 22 years, there are a lot of people making money out there. They're making it very dishonestly, in my opinion. And they're making it because they convince you there's a problem, and they convince you that you have to buy their product to solve it. And in the end, it leaves you nowhere. And then they end up with all the money. It's all the seminars you can attend on how to get rich in real estate. And, and they get you all fired up to go do it. And it's not that complicated. It's buy a house with your spreadsheet, not with your heart when it comes to rentals. Right. Yeah. So you don't need webinars and all these, you pay $500 to go to this thing and they tell you to open up, 10 LLCs and you spin all your wheels doing all this stuff. Stay away from that. Yeah. Just focus on the simple. Keep it simple. Focus long-term, and then keep educating the next generation on how to keep building, without being authoritarian about it. You got to kind of make it fun for them.
Exactly.
So, Brad, we could talk about this forever probably, but I think what it all comes down to is it comes down to planning. Planning is the base of all this. If your financial advisor is not doing planning first, then you're getting sold something. You have to do the plan first in order to know how to build a client's legacy. That's what it comes down to. We talk to people who have millions and millions of dollars in assets, and we talk to people who are trying to figure out how to get there. We're very different in that as a firm, is that I believe that we should help all people, and I think we do that. Sometimes we run ourselves a little ragged doing it, but we do it. And ultimately, you have to understand that you have to have a plan to go execute. We don't go play a football game or any sport for that matter without a plan.
We don't build a house without a blueprint.
Right.
Right.
Everything takes planning. So why do we think that if we just go and talk to an investment guy and we get sold an annuity or a whole life insurance policy that, oh yeah, we're done? That's a product being sold. Maybe those products are good for you, but you got to have a plan first. And so that's the important part. Legacy doesn't just happen. We had somebody evidently won the $1 billion lottery.
Yeah, somewhere in Des Plaines, Illinois.
That doesn't happen to most of us.
No, there's 329,999,000,
right?
Whatever the case may be.
So
yeah,
that
didn't win.
It didn't win, right? So most of us have to work for it. We have to grind for it, and ultimately, the pass on to the next generation. That's even beyond just trying to kill it for ourselves, right?
Right.
So, all right, Brad. Good conversation. Talk to you next time.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.